In this video, you'll learn what bonds are and what types of bonds out there so you'll know what bonds you want to invest in to earn more passive income in the long run. Coming up, bonds are a form of debt security. Simply put, it is a company's loan. Instead of going to a bank, the company gets its funds from investors who purchase its bonds. Perhaps you're asking, why investors buy bonds? They give a steady stream of money. Bonds typically pay interest twice a year. Bondholders receive their entire investment back if the bonds are held to maturity. Therefore, bonds are a good way to save money while investing. Bonds can help to mitigate the risk of investing in more volatile stocks. Companies, governments, and municipalities issue bonds to raise funds for a variety of purposes, including providing cash flow for operations, debt financing, and investing in capital projects such as schools, roadways, hospitals, and other infrastructure. What are the types of bonds? Bonds are divided into three categories. Debt securities issued by private and public corporations are known as corporate bonds. Investment grade, these bonds have a higher credit rating than high-yield corporate bonds, signifying lower credit risk. High yield. These bonds have a weaker credit rating than investment-grade bonds, signifying a larger credit risk, and hence offer higher interest rates in exchange for the increased risk. Municipal bonds, sometimes known as munis, are bonds issued by governments such as states, cities, counties, and other local governments. But before you invest your money, know first the pros and cons of bonds. Bonds can help you save money while still generating a regular return. Bond investments provide consistent revenue streams from interest payments made before the maturity date. Municipal bond interest is normally tax-free on a federal level, and it may also be tax-free on a state and local level for citizens of the states where the bond is issued. Bonds carry risks, just like any other investment. Among them are the credit risk. Bonds issued by the issuer may default if the issuer fails to pay interest or principal. Interest rate risk. The value of bonds can be affected by changes in interest rates. When bonds are held to maturity, the investor receives the face value of the bond plus interest. The bond may be worth more or less than its face value if sold before its maturity date. Investors will be more interested in newly issued bonds when interest rates rise, because newer bonds pay a higher rate of interest than older bonds. It's possible that you'll have to sell an older bond with a lower interest at a discount. Inflation risk. Inflation is defined as a general increase in prices. Inflation weakens purchasing power, causing distress to investors who are paid a fixed rate of interest. Liquidity risk. This refers to the possibility that investors will be unable to acquire or sell the bond because there is no market for it. Call risk. The potential that a bond issuer will retire a bond before its maturity date, something that might happen if interest rates fall. Similar to how a homeowner might refinance a mortgage to take advantage of cheaper rates. Corporate bonds are securities that must be registered with the Securities and Exchange Commission, or SEC, if they are offered publicly. The SEC's EDGAR system can be used to check the registration of the securities. Anyone attempting to sell non-registered bonds should be avoided. If you like this video, leave us a thumbs up, share this with your friends on social media, and also, don't forget to subscribe for more investing videos serving you. Thanks for watching, and see you in the next video we handpicked for you. Take care.